Worst case scenario, the market turns around and it starts to fall. Now, because you've been prudent, you've been sitting on cash, you've been in safe assets, now you can make that switch and then become aggressive.
Welcome into Impactful Conversations, stories and lessons for financial advisors. I'm your host, Dave Edgecombe. Joining me, we got Spencer Lloyd, the head of our advanced resources team at Impact Partnership. We are going to talk about the recent decision for the Fed to cut its borrowing rate by 0.25% and what that means going forward, and looking into the crystal ball even further down the road, because they hinted at this may not be the first cut that they make for 2025. It may lead to more going down the road. I kind of want to get your initial thoughts. And so while I was researching this, it was really tough to not find articles that spoke about the connection to Donald Trump and how the pressure that he's kind of applied to this discussion being a factor in this decision. So I guess first and foremost, what do you make of the quarter rate cut?
Pretty much to be expected for the most part. Individuals that were on both sides of the fence, I think, saw that as probably an experimental rate cut. We don't want to go all the way in, but we also don't want to hold all the way back. Let's put a quarter rate cut on there, see what happens, and then we'll make adjustments as needed, because that is the one benefit that the Fed has. They do meet on a regular basis. So if they need to make those adjustments, they can. So in that sense, then I think it's for the most part universally accepted. And I think the markets kind of showed that accordingly. It wasn't an overreaction to the upside or the downside. It was pretty much status quo.
And despite all that pressure that they've received from President Trump, this is the first cut that they've made since December. So they've kind of held strong and kind of let the market kind of unfold. What kind of came out when we were talking before we got in here was, this is a toe dip. It feels like a toe dip. I imagine in the room, they do the 0.25% and their faces are, okay, what happened? Okay, nothing. Okay. It's very much a, hey, is this light plugged into the wall? Are we going to get electrocuted here? So is that what it feels like from your end, and what your team is kind of going forward with? Is this is very much, the first shoe to drop, but there's definitely more activity kind of on the precipice?
Yeah, I would say that's an absolute consensus, not only with my team, but probably industry as a whole. Whether that's stock markets, whether that's individuals investing in fixed income, whatever that might be, it's pretty much status quo. And then all of those external forces that you had mentioned prior, whether it's politics or individuals trying to, the president specifically trying to influence what happens. The one thing that I would say to that is historically, if you look back on the current Fed board, is they are data driven. And no matter typically what anyone says, they're going to follow the data and make adjustments as necessary. So there's pros and cons that come to that. The pro is that they truly remain independent, and they're not going to make an emotional decision. They're going to look at the data and they're going to make the appropriate decision that they feel will help to stabilize the economy. Now, on the flip side, by just looking at today's data doesn't necessarily tell the full picture, right? So you can make decisions late, you can make them early. It's easy for data to either be incorrect or data to change on the drop of a dime. And if you're not meeting on a every single day basis and putting out reports every single day, then there's a little bit of room for potential error, falling behind. And I think a little of that showed when they were raising rates. In all reality, they were behind when they raised rates. So now are we seeing that on the downside? Are they trailing? Are they ahead of it? Where are they at? So it'll be interesting to see what happens. And there's a lot of what ifs along the way. But it'll be interesting to see what kind of stance they take as time goes.
Is it the unemployment in the job market overall that dictated their decision here? That was what I was seeing. Is that the sole thing?
Yeah.
So
factor? That seems to be what everyone's leaning on, is the employment data. There's always the inflation data as well. So it's a seesaw, right? If you affect one, it's going to affect the other, and vice versa. Very rarely are we going to go up in parallel. So something has to suffer in some regard in order to maintain a little bit of stability of sorts. But yeah, for the most part, it seems like the employment data has been a major target, and rightfully so. It is an important aspect, because if we have unemployment at all-time highs, then obviously the economy as a whole is struggling in some regards.
Yeah.
Now, you may not see that across the board, because you're going to have different companies, individuals that are weathering this storm and continuing to be successful. This isn't like a housing market crash or anything like that. This is a different world that we're kind of going towards in regards to that. Really, truly, the wealthier are getting wealthier, and there's starting to be that growing gap between the 1% and that middle to lower class. So where the economy goes, where interest rates go, it's going to dictate what happens to that gap. Is it going to get bigger? Is it going to get smaller? We'll see. We'll see.
I thought when we sat down that I was going to get you charged up on like sort of the political component to it, and the more I kind of peeled it back was,
Mhm.
whether it's irrelevant whether it
Mhm.
was political or not. It is what it is, and the unemployment rate in the job market is one of those litmus tests that they're using, but the other one is inflation.
Mhm.
And I think that's the one that might get you charged up, because I know that you also kind of have one position, and our president here at Impact, has
Yeah.
a different position, and he
Right.
feels a different way about it, because, it is sort of, how do you view economics, and how do you view individual
Mhm.
spending, and what you think the danger of a cut means
Mhm.
for inflation.
Yeah, and so kind of my point of view is what I take is both from a data perspective, but then also from an emotional standpoint. So if you go around the building or you go out into the public and you talk to individuals out in the street, how comfortable are you? How are you feeling? And I mean, I can speak for myself and my family, and I'd say that I don't feel like I'm in a better place. Yes, have my wages gone up over the past 4 years? Absolutely, but do I feel more comfortable,
Yeah.
or do I feel more stretched thin because of the cost of everything going up? And although prices have come down, they haven't really come down that much. In all reality, there's certain avenues that have come down. So it's for me, it's a little bit of a balance between the real actual data in front of you, and then also the sentiment across the general U.S. population. Because it's easy for these big economists and your J.P. Morgans and First Trust and whoever that might be to come out and say, "Hey, this is what we see. This is what needs to happen." But how closely are they tied into the average individual and what their spending habits are?
I was going to have you look into a crystal ball. We won't do that just yet, but I do think that there's more to come kind of
Hmm.
down the road. Um, you mentioned the people, the experts.
Yeah.
So I got a couple of quotes written here. This is from Simon Dangoor, head of fixed income macro strategies at Goldman Sachs Asset Management. We think it would take a significant upside surprise in inflation or labor market rebound to take the Fed off its current easing trajectory. What do
Mhm.
you put? What kind of stock do you put in someone of that stature?
Mhm.
Kind of issuing their thoughts, and what would a financial advisor think about someone like that kind of wading into the ring to give you their 2 cents?
That's where you really have to take dissenting opinions, because there's so many different what ifs that are out of everyone's control in all reality, that take the opinions of 10 different people rather than just one individual, and dictate your own idea or thesis on what to do from there. Whether that's, hey, we're going to get a little bit more safe, but we'll maintain a 30% into some risky assets that we know can weather the storm. Or if it's a very conservative advisor, or you have a client that's extremely conservative, tight budget, then we need to de-risk altogether, because there's so many what ifs out there that one small flip of the switch could completely change everything. Think about it tomorrow. If Jerome Powell decides, you know what, I'm tired of hearing the voice across the aisle constantly berating me. I'm over this. I'm old enough. I can retire. You know what? I'm done. So now the next Fed chair that comes in could be in pro of plummeting
Different. It
rates.
could be
Yeah.
different.
Or,
Let's
or,
just
or
say,
vice versa,
yeah.
whatever that might be. So that's where you lose a bit of control. So it's a matter of understanding what's in front of you right now, what your thought process is, what the experts as a whole, kind of what that consensus is, and really lean into that and make an educated decision that's not dramatic one way or the other. As we came into yesterday for the Fed rate cut, I would say the overwhelming consensus was is 25 bips. Now, there's going to be people that think one way or the other, and I would be one of those individuals. But as a whole, I was 99% certain that it was going to be 25 bips, and that's just once you hear it 100 different times or 100 different powerful individuals in the finance industry, there's some weight behind that,
Yeah.
right? They're bigger than me. They know more than me. They have the resources. They have the lobbyists. They have the individuals that are tied in with every single day numbers. So I'm going to have some level of trust in them, but still also maintain my own personal opinion and thought process of what I just see on the ground floor.
A lot of the articles that I saw were made the connection between mortgage rates and
Mhm.
what the opportunity is for the average American there. And you mentioned refis. Is that the obvious one for the average person, not pre-retiree specific?
Yeah, I would say refis are going to be a huge one. Anyone that's bought a house within the past few years, it's going to be a big opportunity. It's going to be a big opportunity to put more money back in their pocket by paying less per month on their mortgage. Now, it's a double-edged sword at the same time because you're going to have a lot of individuals, and I have a lot of personal friends as well that have sat on the sidelines waiting for their opportunity to buy a house, and frankly they haven't been able to because what they could afford 3 or 4 years ago all of a sudden is well out of their price range. But now as mortgage rates start to ease, now it's all right, we can start that conversation again. So I anticipate it'll bring more buyers to the market, which what is that going to do to the cost of houses as a whole? You're going to have more competition now. So it's a little bit of a double-edged sword. Yes, interest rates are lower, it's more affordable, but that means your buying power is stronger.
Well, I'm wondering if it
So
kicks in a sense of urgency now that then has
right.
that effect on the housing market in general, and you
Right.
get all of a sudden that seller's market.
Mhm.
Do you think that's a real possibility
It
before the other shoe drops?
it very well could be, and there's a lot of different elements that can go into it, but my guess would be that we could have another potential run in the markets, not as strong as you saw in COVID because those were all-time low rates that we'll probably never see again. But it could be really interesting to see if the value of houses go back up again because all right, I can afford this $400,000 house where before with interest rates 2% higher, I could only afford 200,000. So it'll be interesting, and so the other element that I would say that comes of that is what's people's fiscal responsibility in having that extra money.
Okay.
Do they pay down debts that they currently have? Do they overextend themselves because they've always wanted that really nice house? And so it'll be interesting to see what the human and emotional dynamic is when that happens.
That's the danger of the inflation, and I would imagine is, yeah, here's $1,000, spend it wisely. Well,
Yeah, yeah. When you hand someone $1,000, they're not going to put it in their savings account. They're going to spend it.
what is the opportunity for the bond markets, or is this too much of a toe dip for there really to be that sort of movement and a real opportunity for an advisor to kind of jump on?
I would say it's experimental right now. So there's nothing of any significance up or down. This is purely I see it purely as an experimental toe dip. Depending on what happens to it, that will dictate whether they continue more rate cuts, whether it's a consistent basis. In a perfect scenario, we get a consistent 25 bips over the next few months, and we get a reduction of 50 bips or a full point by the end of the year, and the economy stabilizes. That's the best case scenario, which I think everyone would hope to see.
Will this have a direct effect on interest linked assets like CDs?
Yes, absolutely, it should. Now that's where the inflation part comes from. Is how does treasuries react to these falling yields? So, um, or increasing yields, I should say. So, borrowing should uptick, but then there's other avenues the what ifs that you have to consider is where's foreign investments because more and more we see more and more foreign investments, but if the dollar weakens, then there's not going to be as much cadence for them to do that anymore. The U.S. is not going to be as strong of an asset as it once was. So you start bringing a lot of what ifs in that scenario. But I would say right now it's purely experimental. They're trying to see what happens if there's any significant upticks in any different metric that they watch from a data standpoint, and then they'll make their adjustments accordingly. Unfortunately, it's one of those things that we just have to wait and see, which is one of the scariest things at the same time.
Even with it being, as we've said, a toe dip, is there another avenue asset wise that kind of jumps off the page to you that is you can kind of maybe avoid some of the uncertainty of what the next 6 months are going to look like potentially?
Um, Prudent financial planning is one, absolutely.
I mean, diversification, obviously, right?
Absolutely. Diversification. And it's one of those things that if you're in a good position, stay the course. Um, because as these things start to ebb and flow, you don't want to put yourself in an opportunity to miss out, right? So let's just assume you have a house or you have a lot of cash on hand, whatever that might be. Worst case scenario, the market turns around and it starts to fall because of everything going on, or recession looms, or whatever that might be. And now, because you've been prudent, you've been sitting on cash, you've been in safe assets, now you can make that switch and then become aggressive. As Warren Buffett always says, buy low, sell high, for one, but then also um, sell the new or not. Most people sell the news and then sell the news for the most part, where he goes in and he buys the news.
Mhm.
So when everyone's running away, he's running in, and that's part of that emotional dynamic of the average consumer and investor, right? Is they see red flags everywhere. I'm going to stay off the sidelines. I'm going to wait for things to turn around, and then I'll put my toe back in and see if it's good. Whereas everyone else, the one percenters, the individuals that are getting more and more wealthy, are, hey, that's going down, but it's a good asset. It's a home, or it's a whatever it might be. I'm going to buy it. And then when it goes back up, I'm going to sell it to the people that have been sitting on the sidelines.
Yeah. Is that the kind of opportunity that the savvy investor's looking at and preaching to their clients?
Absolutely.
Like what are those conversations looking like from a financial advisor to maybe someone that's been retired for 5 years and sees this and thinks, I got to do something
Yeah.
here?
Yeah. So there's a couple different ways to look at it depending on their investment thesis. So if we're talking fixed income like annuities or fixed rates or anything like that, right now we're at all-time highs. I would say there's a really high likelihood that we're going to get a continued decrease. And based on some of the conversations that I've been having with a lot of our massive carriers, are yeah, the coffers are getting full. So we're going to start pulling rates, and the pricing that things are at are no longer sustainable. So to get ahead of the game and not put themselves in a financially precarious situation, we're going to peel back. We're going to peel back rates. We're going to get more profitable, et cetera. So the other element of that being is um, so that's the fixed income space. The other element of that being is the market as a whole. So that's where you have a lot of these institutional investors still in the market because their signals are telling them to stay in. Whereas valuations are coming to all-time highs, which goes against everything that you would think. So with our world getting so much more intelligent, and the development of AI and algorithms and et cetera in that world, is that when is AI and when are those algorithms going to switch and say, you know what, we got to get out. The valuations are too much. And guess what? That AI and those algorithms are going to be a hell of a lot faster than the average investor. So by the time they catch it, the algorithms and everything have already made their move. They're done. They're good. So I don't want to say it's going to be like, all hands on deck, red flag, blah, blah, blah. It's the end of the world. I don't think that by any stretch of the imagination. There's going to be segments, though, that are going to be a lot stronger than others. And so then it comes down to that advisor and that client identifying what those segments are that are going to weather the storm, whether that's a home, whether that's a certain stock, whether that's a CD, whatever their risk tolerance is.
So I said I was going to have you look into a crystal ball of sorts. I want to rattle this quote off from you from Dan North, chief economist, Allianz Trade North American. I don't think that's risk management in reference to the cut today or the other day. I think that's steering the ship. It is sort of an ebb and flow, and it is a process, and it's a really hard job, and it's really hard to get it right,
Yep.
right on the dot. So the articles that I've read have hinted this is maybe the first move. It's not going to be the last. What needs to happen in your crystal ball for you to be concerned one way or the other in the next 6 months or before the year closes out?
I see unemployment as an issue. I personally think that inflation is a bigger issue and something that we need to keep a lot closer eye on. So depending on how inflation reacts to this, to me, is what we need to keep a closer eye on. And the one thing that kind of goes along hand in hand with that, which is kind of weird to say, inflation is consumer debt load. And as of most of the reports coming out, it's at all-time highs. So are clients overspending and just continuously borrowing money to get the things that they want, that they used to be able to afford, that they still want because it makes them emotionally feel better and get through the chaos that's in our world today, from news to whatever's happening on in the world. So in my crystal ball, I'm watching inflation. That's just me, because I want to know how strong my paycheck that's coming in is. Can I afford to do these things with my family? Go on a trip? Can I go on some of the more what is my grocery bill? Do I need to find a different place to shop? Am I going to Aldi instead of Publix type
Yeah.
of deal? So to me, inflation, and that's going to hit the middle class to the lower class a lot harder than it will the wealthy. The wealthy are going to continue to spend because their dollar does not stop coming in.
What do you think in terms of a timetable for, it's September now, and they
Mhm.
said they want to potentially make two more
Yep.
moves. I don't know if they're all cuts, but two more moves before the year ends. How long do you think we're sitting at a quarter rate cut before it jumps to something else?
I think if we stay relatively stable, I wouldn't be surprised to see some more rate cuts. If we continue to see unemployment increase, then I think we'll see more rate cuts, which I anticipate happening for a handful of reasons. One, how profitable are companies, or what is their cost for doing business? But then also the other element of it, that's the part of the what ifs, is AI. It's coming in. It's replacing administrative jobs. It's replacing day to day granular tasks that don't have to be done by a human, right?
Yeah. How does the
So
job market keep up with that sort of innovation?
yeah, so that's your what if that's out there, is if that continues to ramp up, which I anticipate it will, that will drive up unemployment, which will effectively hurt the economy. But where do we go from there? Like, is cutting rates the best source of fixing this problem? That's it's not really a rate problem at that point. It's more of a technology problem. And how are those individuals that are losing these types of jobs, what are they doing now? How are they recontributing back to society?
Yeah.
Because AI is not going away. It's just going to become a greater and greater aspect of our life. As I kind of showed you before we started all this, the
Yeah.
chaos that's going to ensue. And you might be interviewing a speaker here soon.
Well, not if I have anything to say about it. So I thought this was just going to be a run-of-the-mill Fed conversation, and we somehow got to AI. I knew I'd get you charged up. The one thing that got you was talking about algorithms. I didn't think that would be the thing, but algorithms got you triggered. So I'll file that away in the cabinet to see when I want to when I grind Spencer's gears down the road. Spencer, thank you. I hope this was informative, and I think we touched on everything that we could touch on in a 15-20 minute long podcast, and we'll keep our ear to the ground to see what the next move is, because I think we all can agree that there is a next move coming.
Yep, I would say strap on and get ready for the next year. See what happens.
Okay. If you're looking for better ways to grow your practice or to stay in tune for what the latest in the industry is and in the market, our YouTube channel is a great resource. House Rules, Selling with Stories, they're all a great opportunity for you to grow your practice and learn some ins and outs along the way. So, Spencer, once again, thank you so much, and we'll see you next time.